澎湃新闻的各位观众朋友们，大家好，欢迎收看澎湃新闻首席连线节目，我是澎湃新闻记者丁欣晴。2024年以来，亚洲各国宏观经济复苏节奏并不同步，四大经济体有各自独特的驱动因素。那么，在美联储释放降息信号的大背景下，亚洲市场未来走势将会如何？哪些国家及相关板块值得我们重点关注？全球投资者在现阶段对中国资产的态度是怎样的？本期我们非常荣幸地邀请到了 Goldman Sachs 高盛亚太区首席股票策略师慕天辉 Timothy Mo 先生，与我们共同分析探讨亚洲股票市场表现、宏观因素影响以及中国股票市场机遇等相关投资议题。高盛集团成立于1869年，是全世界历史悠久及规模最大的投资银行之一，总部位于美国纽约，集投资银行、证券交易、资产与财富管理等业务为一体。慕天辉先生拥有近40年的从业经验，自2002年起便加入了高盛集团，目前担任高盛亚太区首席股票策略师、亚洲宏观研究联席主管。此前，他在高盛全球宏观论坛上分享了他2024年关注的3大亚太区投资主题：日本推动公司治理改革、印度制造及中国再平衡。他强调，股票的盈利能力仍然是股价表现的关键驱动力。Good afternoon, Mr. Mo. Welcome to our program, Interviewed with Trips. I'm Xin-Qing Ding, reporter from the paper. How are you doing today?
Everything is great, and thank you very much for having me on your show.
Thank you for taking time to do this interview with us. We understand you have a super PAC scheduled in Hong Kong. Well, in the next 30 minutes, we are keen to understand your views on regional equities market, including China, the impact of macro global factors, and investor sentiment. First, let's talk about Fed rate. Goldman Sachs Economics expect the Fed to cut the policy rate at the 12th June FOMC meeting and to cut in September and December for 3 cuts this year. How will this impact the Asian equities?
So you are right that we and also the consensus are now expecting the Fed to cut 3 times starting in June. The important point to understand is that the markets have responded to the first time the Fed has started to cut rates in a different way depending on whether the U.S. economy is in a recession or not in a recession. Since 1988, which is the modern financial history for Asian equity markets, there have been 8 times that the Federal Reserve started to cut interest rates. In 4 of those episodes, there was a recession. In 4 of those, there was not a recession. We currently do not expect the U.S. to be in recession. We have a strong growth outlook. Our economic forecast is above the consensus. So we look at the examples when the Fed started cutting and there was no recession. The good news is that in the 1, 3, and 6 months after the Fed started cutting, when there was no recession, the Asian equity performance was quite strong, both in terms of the average return and also in the probability of having a positive performance. So our baseline expectation would be that Asian markets respond favorably to the start of a Fed cut, especially because we think that other Asian central banks, or most Asian central banks, will also begin to ease their rates. Now, the last point I would like to make is that markets have performed well in the first quarter of this year, and valuations have expanded, particularly in places like India. So maybe some of the positive effect of lower Fed interest rates is already priced into the stock markets. So the bottom line is we expect a positive result or positive response, but maybe not as dramatic as we've seen in the past because the valuations are already high.
Okay, besides rate cutting, in your recent research note, We noticed that you mentioned other factors likely to influence Asian market performance in the coming quarter, such as one-quarter earning results, market-specific policy, and seasonality. Could you elaborate this?
Yes, so we think that there are 5 key factors that may influence equity market returns in the coming quarter. We've just discussed the first and very important one, which is the potential start of a Fed easing cycle. But there are 4 other factors that are also important and are likely to influence the performance of stock markets. The first one is politics and geopolitics. And here we subdivide this into 3 comments. Number 1, the US election, which is still 7 months away, but already we know the candidates, and clearly this will have some influence because of the importance of the US economy. The key insight here is that if you look at all the US elections since 1988, and there are 12 of those that have happened, if we look at how Asian markets performed going into the election and then after, there are 2 key points that we can make. Number 1 is Asia typically trades well after a US election. It might be for different fundamental reasons, but that's the clear evidence over time. And number 2, there has been a very clear market performance differential between whether a Democrat or a Republican comes in. The historical record is that the markets and sectors have almost all done better when there was a Democratic victory compared to a Republican victory. I want to be clear, this is no comment on the current election contest. We're not saying anything about Biden versus Trump, but just saying in the historical record, the outcome has been better with a Democrat than with a Republican. Now, the last point I want to make, and this goes into the comment on geopolitics, is that it's likely that the commentary on China in the course of the U.S. political race may become somewhat more hawkish. The point here is that we have several tools we've developed to monitor how the markets are pricing geopolitical risk. And when we look at the components of that, we can see, for example, that the trade component, the market is pricing greater concerns about trade, for example, than it is about capital markets. And I think that makes sense in the current environment because the market is now less focused on, for example, the ADR delisting risk, which was very topical a year or so ago, but is less of a concern now. But given the threatened 10% tariff surcharge or increase that candidate Trump has suggested, the market is now pricing greater degree of trade risk. So we just want to flag to investors that this is something that we need to be watching as we go into the second quarter. The last point I'll make away from China is that there are important elections in India and also in Korea, and those are ones that investors need to monitor. So that's election and geopolitics. Quickly, earnings is also always important, but especially so because valuations are broadly fair right now. Therefore, the main driver for equity markets will be earnings delivery by companies. So investors need to keep a close watch on that. Lastly, 2 things. Domestic policy, particularly in China, where we believe that continued policy support for the economy and for the equity market will be important to enable the rally we've been seeing from the lows in January to continue. And in Korea, we expect further detail on the Value Up program, which is very topical and exciting in Korea. The very final thing I want to mention is there is a strong seasonal return pattern in the second quarter across all the markets in Asia. Typically, April is a good month. May is a much more difficult month, and June is more or less flat. So your starting expectation for the second quarter should be a good start and maybe some more difficulty in the middle of the quarter, before we get to June. But this year, my final point is that there may be somewhat of a contest between the difficult seasonality, which is the pattern I mentioned, compared to the imminent cutting by the Fed, easing of interest rates. So I think there will be a bit of a struggle between challenging seasonality versus supportive monetary policy. And that will be something for investors to keep a close eye on later in the second quarter.
Well, obviously, Japan is a market that attracts a lot of attention this year. Since the stock price is at all-time high now, do you think Japanese stocks will keep going up? What sectors should investors focus on?
The quick answer is yes. We think Japan can continue to make further gains in terms of its equity market. And we've had a strong and continuing positive view on Japan, really because of the bottom-up corporate change which is taking place, which has been driven by the Tokyo Stock Exchange, encouraging companies to focus more on their primary business, to reduce their cross-shareholdings, to raise their return on equity, and also to return more cash to shareholders. So this aggregate program of improving corporate governance and corporate focus is a change that investors are embracing in Japan, and which we think has further to go, especially because the underlying earnings in Japan are still good. So the fundamental corporate earnings is still 8 to 9% for this year and next year. And even though the market has, as you mentioned in your question, gone to all-time highs, where the Nikkei has surpassed its 34-year-old record in December of 1989, it's important for your viewers to understand that even though the price level has gone higher, the valuations are completely different than they were 34 years ago. 34 years ago, in late 1980s, there was a bubble in Japan, and the market valuation was 60 times earnings, 8 times price to book, very, very elevated levels. Today, even though the market has had a very good run, we're trading at 15 to 16 times forward price earnings ratio and maybe 1.5 times price to book. So really, really different valuation levels. So the conclusion here is that we recognize the market has done very well in the first quarter. The Topix index in local currency terms is up 19%, so a very strong quarter. There may be some consolidation or digestion of the gains, but we expect further gains to the end of the year, and we have a Topix target of 2,900 compared to the low 2,700 level currently. Your question about sectors, we would maybe pivot the response a bit and answer your question this way, that we've just refreshed our views on which stocks may be more likely to improve their corporate performance, and we've screened for stocks along 7 key criteria. And so this is something which we think is the key theme in the market, and that is that theme of corporate change is one that we would encourage viewers to focus on, and that is how we would be doing our stock selection in the current environment.
We know that Bank of Japan confirmed the end of negative interest rate policy. In your opinion, how will this impact the Japan stock market?
So that is a well-asked question, and it's important for your viewers to understand that the market reaction, particularly the foreign exchange market reaction, was somewhat different than many investors expected going into the Bank of Japan change. To give a bit more detail, the expectation, of course, was that the BOJ would exit its longstanding negative interest rate policy. And typically, if a central bank tightens interest rates, that one would expect that the currency would strengthen. when interest rates go up. In fact, the opposite happened, and the Japanese yen weakened. So the yen dollar rate went above 150, and in fact just exceeded its previous long-standing high of 152.93. So 151.93. Sorry. So my point here is we need to understand why that happened. The reason why it happened is that the Bank of Japan's move was perceived by the market as being a dovish hike. What I mean by that is that the Bank of Japan increased interest rates by 10 basis points as expected, but the guidance by Governor Ueda was more dovish than people were expecting. At the same time, in the United States, the expectations for the Federal Reserve cutting have reduced from 5 cuts to 3 cuts now. So if you look at both sides of the currency pair, the yen looks somewhat less strong in terms of the hike, and the dollar looks less weak in terms of the expected cuts. What that means is the market is now focusing on the absolute differential in rates and thinking that the wide spread between US rates and Japanese rates will remain. That is why the yen weakened, because the market looks at the yen as a funding currency to go into, say, dollars and get higher return. The point of all this is that if the market has pivoted to a slightly stronger dollar view and a somewhat weaker Japanese yen view, then that is actually more positive for the equity market, because typically the Japanese equity market does somewhat better when the yen is weakening, principally because there tends to be more of a tailwind for earnings in local currency terms. The last point I'll make is our rough rule of thumb, a rough yardstick, is that for every 10 yen move in the US JPY rate, there's a 3.5% increase in corporate profits. So we've had about a 5 yen increase in our forecast. We've changed our forecast. That might map onto an additional 1 to 2% improvement in earnings, which of course would be favorable for the stock market. So I think that's the way to understand how to map the BOJ moves onto the implications for the equity market.
Okay, what other markets in the region will perform well in your opinion?
We have a number of other markets we like, but let me just focus on one in the interest of time and simplicity, and that is Korea. So we are very optimistic on Korea, and the simple way to summarize our view is in 3 layers. Think of maybe a 3-layer cake. So the bottom layer of the cake is that Korea has without argument, is the strongest cyclical recovery story in Asia. And the reason is that a large part of the Korean index is the semiconductor stocks, which are very deeply cyclical. They had a very tough year in 2023, where they either had a very sharp drop in profits or even had 1 or 2 quarters where they were making losses. Already they're beginning to recover, and we expect over 60% increase in earnings this year. So there will be a very sharp increase in overall Korean earnings this year, and the market is trading still at inexpensive valuation, just 1.1 times price to book. So that's the bottom layer of the cake. The middle layer, the next layer, is that there's AI exposure to the artificial intelligence theme. And this gives extra fundamental support, but also extra positive sentiment to the market. So that's an additional layer. And then the top layer is the corporate change dynamic, the so-called Value Up program, which was just announced about 1 month or 6 weeks ago in Korea. And this is something which very much is emulating or copying what Japan has been doing for the last year, and which has been very successful for the Japan equity market. Korea is introducing a similar program, which gives an additional theme of corporate change and closing or narrowing the long-standing Korea valuation discount to other markets. So if you put those three layers together, it makes for a compelling investment case, as I said, at a low valuation and where foreign investor participation is still very low relative to historical norms.
Now let's move on to China. What are the focuses of international investors in Chinese equity and why? How's the appetite of global investors from different regions?
Yeah, so there's a lot to say on China, and I'll try to be as clear and concise as I can. First, it should be no surprise to you that the general view by foreign investors on China is much more cautious, really over the past year, 1 or 2 years. And this is because we are now more than 3 years into the bear market. The start of the bear market was February 18th, 2021, and we just passed that anniversary over a month ago. So it's been a long downward move for Chinese equities, where from the peak to the recent low, the MSCI China index fell 62%. So not surprisingly, when you have a long-standing bear market, people's sentiment is correspondingly negative. And for some understandable fundamental reasons, because as is well known now, China has a number of structural economic challenges. So that's sort of the negative backdrop. All that being said, as investors, we have to understand that we need to consider not just the fundamentals, but also how much is discounted into share prices in order to frame a view on how share prices may perform in the future. And our view has been that even though we recognize the fundamental challenges that China is facing, that a lot of this adverse news was already well reflected in the valuation of equities. So just to give you 1 or 2 numbers, the peak valuation for China in 2021 was 18.2 times forward 12-month earnings. The recent low we made in January was 7.9, 18.2 to 7.9. That's a very significant derating which happened. Additionally, when we look at positioning data, we can see that foreign investors are really at the lowest levels of exposure for the past 10 years. So positioning is light, prices are down, and the valuations are down as well. So our view has really been 2 things. Number 1, that there was a chance for at least a good trading rally in the market. And number 2, we've been preferring the A shares over the offshore so-called H shares. So far this year, both of those views are doing reasonably well. We've had about a 15% rally from the January 22nd low to the recent high for the MSCI China index. There's been a bit of a correction, but net still up about 13%. And the A shares have outperformed the H shares by about 400 to 500 basis points. So I think the reason for this has broadly been 2 things. Number 1, there's been more visible policy support for the economy and for the stock market through the national team support. And number 2, if we look at the earnings for the 4th quarter of 2023, they clearly are coming in better than the previous quarters. Still not great, but clearly we're seeing some stabilization of profitability. So on a forward-looking basis, our view is that if we get continuing policy support for both the market and maybe and certainly for the economy in various dimensions, monetary policy, fiscal policy, housing, etc., and also we see Chinese corporates being profitable, then we think that the rally, which we're currently seeing, can continue somewhat. The last point I'll make to your question is, what part of the market do we like? Our broad theme that we like the most is what we call the China rebalancing theme, which is the overarching idea that China needs to shift its focus from property and debt-fueled infrastructure investment to the higher productivity, newer economic sectors, which would include higher technology, advanced manufacturing, green economy, mass consumption, improving the performance of state-owned enterprises, and then encouraging companies that are very competitive in China to to go global and to seek greater opportunities outside China. So this overarching theme of China rebalancing is really the core one. And of course, that's where government policy is really focused on pivoting China. So we think that if investors are investing in harmony with government policy and in the areas where there's clear focus and China is making structural and strategic progress, that is where the greatest opportunities lie.
Okay, finally, let's talk about opportunities and risks. What are the promising sectors or themes you see in China, and what are the risks that people should pay attention to?
So in terms of sectors, I briefly did summarize the parts of the market that we like. We like lots of things to do with technology, particularly hard technology, advanced manufacturing, and so forth. We think that looks very good. Some of the platform companies, they've stabilized. They've absorbed the changes to the regulatory environment. The valuations are quite low, so there's a number of names we like there. There's parts of the lower end of the consumer sector which we like, and there's a number of different sub-themes there which we've been publishing on. The green economy is something which we are very focused on because it's very clear China is trying to improve its energy self-sufficiency with significant investment in alternative energy, where China is a world leader in solar and wind and so forth. So there's a number of strong investment opportunities in that regard. Quality SOEs is something that we like, where SOEs are being encouraged to improve their performance. There's an echo here of what I said for Japan and for Korea in terms of China trying to improve corporate governance. So many different sub-themes in the market that we like. Turning to risks, we've summarized some of those already, but I'll emphasize those. I think the overarching risk is that we have the continuing adjustment in the property sector, which we think is going to take still some years to work out. And that's going to be a continuing drag on growth. And also there are other areas where debt needs to be addressed, particularly for local government financing vehicles. So there are some significant fundamental macroeconomic challenges that China needs to navigate through while it's trying to grow the newer parts of the economy. So how China manages those transition risks is one area that's important. The next area is that sentiment, I'd say private sector confidence has been affected by all the developments of the last several years. And so consumer confidence is fragile. Retail sales are sluggish. People have taken some pain in their balance sheet because of property prices coming down. So consumer sentiment needs to get strengthened. And I think private sector entrepreneurial sentiment could also be strengthened. So getting those so-called animal spirits back, the confidence of the private sector, I think is going to be important. And then the last area I'd point to, of course, is the geopolitical environment. There are, as I mentioned earlier, it's an election season in the United States. That may, at least optically, raise the tension because of just the political debate. There are a number of more tangible issues. For example, the Biosecure Act in the United States, which is having some negative effect on the China healthcare sector. So there are a number of, I guess, geopolitical issues that need to be navigated as well. So there's plenty for investors to be mindful of and plenty of risks to be aware of, but there also are many opportunities. And my final point here is that suggests that active investment, in other words, not just having an index following passive attitude, but having an active ability to do the analysis and to select the better parts of the market, to understand the valuations, understand the competitive dynamics. All these active investment tools will, we think, be very helpful in being able to generate some positive return in the Chinese equity universe.
Thank you very much, Mr. Mold, for being our guest today. Your insights are highly appreciated. I hope one day we can have you sitting with us in our Shanghai studio.
I look forward to that. Thank you very much.
好的，感谢 Mo 先生的精彩分享。 相信不仅是我，屏幕前的观众朋友们也对亚洲股票市场宏观因素影响和中国资产配置机遇有了更加深刻的认识。时间关系，本期首席连线节目到这里就要告一段落了。感谢各位观众朋友们的收看，也再次感谢某先生。观众朋友们，我们下期见。